The setup is already in motion, not next week, not next month, but tomorrow. Silver closed strong. Confidence is rising, but beneath the surface, something is quietly shifting. A market where supply is tight, yet prices are about to fall. A contradiction that does not happen by accident. Every signal says strength, every structure says pressure, and right in between is where the trap is set. Because what looks like a crash may not be a collapse at all. It may be something far more calculated, something designed to make investors do exactly the wrong thing at exactly the right time, and by the time most people understand it, the move will already be over. Welcome to Financial Crisis Explained. If this kind of analysis matters to you, then consider subscribing, not quickly, but thoughtfully, like someone who understands that the right information at the right time can change financial outcomes. And before we begin, comment below where in the world you are watching this from. In global markets, not every trading hour carries the same weight. Some periods are deep, stable, and efficient. Others are thin, emotional, and highly vulnerable to sudden disruption. Monday's opening session often belongs to the second category. It arrives after a weekend of headlines, speculation, geopolitical developments, and private repositioning by large market participants. By the time public traders return to their screens, the first move of the week is already competing with 2 days of accumulated uncertainty. That dynamic matters in every asset class, but in silver, it can become far more pronounced. Silver is not simply another commodity. It sits in an unusual position between monetary metal and industrial input. It trades partly as a store of value, partly as a growth asset, and partly as a macro hedge against monetary instability. Because of that dual identity, silver often attracts different categories of capital at the same time. Inflation traders, industrial demand analysts, safe haven buyers, momentum funds, and short-term speculators can all be active in the same market for entirely different reasons. When multiple motivations converge in a market that is smaller and less liquid than gold, price behavior becomes more sensitive to timing. This is where Monday becomes strategically important. The opening hours of the week frequently begin with lower participation than peak weekday sessions. Not every institution enters immediately. Not every region is fully active at the same time. Market depth can remain thinner than normal, which means fewer resting orders are available to absorb aggressive buying or selling. In such an environment, price can move faster than many participants expect. To the average observer, a sharp early decline may appear to be a spontaneous rejection of silver, but structure often tells a different story. In thin conditions, it does not always require a major change in fundamentals to produce a dramatic chart move. Sometimes it only requires concentrated execution during the right window. That distinction is critical. Many investors are trained to read price as truth. If silver falls quickly, they assume new negative information must exist. If it rises strongly, they assume confidence has returned. But markets do not always move in straight response to facts. They also move in response to liquidity, positioning, leverage, incentives, and timing. Price is information, but it is not always complete information. At the moment, the broader environment makes this even more relevant. Gold has remained elevated, signaling continued concern around currency stability, sovereign debt burdens, and long-term purchasing power. In previous cycles, strong gold performance often redirected attention toward silver, especially when investors began searching for relative value. Historically, when precious metals trends mature, silver can begin moving faster than gold due to its smaller market size and greater volatility. That possibility changes behavior before it happens. If enough traders begin expecting silver to outperform, speculative long positioning can build quickly. Momentum funds may increase exposure, retail participation may accelerate, short-term call options may expand, social media narratives may intensify. In other words, expectation itself can become fuel. And when expectation builds inside a leveraged market, pressure points emerge. Large participants understand this. They monitor where positioning is crowded, where stop-loss orders are likely clustered, where options exposure becomes sensitive, and where liquidity is weakest. They do not need to control the market to benefit from these conditions. They only need to recognize where the structure is fragile. Monday often provides that opportunity. A sudden wave of selling during low-depth conditions can trigger technical breakdown signals. Those signals can activate automated systems. Falling prices can hit stop-loss levels placed by leveraged traders. That forced selling can push prices lower still, creating a cascade that appears larger and more organic than the initial move that started it. To those watching headlines, it looks like silver is collapsing. To those studying mechanics, it may look like a chain reaction. This does not mean every Monday decline is coordinated or every sell-off is artificial. Markets can fall for legitimate reasons. Economic data can weaken, real yields can rise, industrial forecasts can deteriorate, currency conditions can shift. Genuine repricing happens regularly, but serious decision makers do not assume all moves are identical simply because they share the same direction. They ask harder questions. Why did the move happen during that specific window? How much volume was required relative to the price impact? Did fundamentals materially change, or did positioning unwind? Were physical market conditions aligned with the paper move? Who was forced to react, and who was prepared in advance? Those questions separate passive spectators from strategic observers. For entrepreneurs, investors, and business leaders, the lesson extends beyond silver. In any competitive environment, visible outcomes are often produced by invisible structures. By the time the public sees the headline, the underlying mechanics have usually been in motion for some time. That is the real importance of Monday. It is not merely the first trading day of the week. It is often the moment when hidden pressures meet public perception, a time when timing can overpower narrative, a window where those who understand structure may act with patience, while those who only see price may act with urgency. And in markets shaped by leverage and psychology, urgency is often expensive. Most people believe a market price is the cleanest expression of supply and demand. If something is scarce, the price should rise. If demand weakens, the price should fall. In theory, that logic sounds complete. In practice, the silver market operates through layers of structure that many participants never see. What the public calls the silver price is often not the price of a coin, a bar, or metal being moved into a vault. It is frequently the price discovered in the paper market, where contracts trade in enormous size, often changing hands many times before a single ounce ever moves. That difference changes everything. A futures contract can create exposure to silver without requiring immediate ownership of physical metal. For producers, manufacturers, refiners, and commercial hedgers, this system serves a legitimate purpose. It allows risk to be transferred, inventory to be planned, and future costs to be managed. But once leveraged speculation, algorithmic execution, and large-scale directional positioning enter the same arena, the futures market becomes more than a hedging tool. It becomes the dominant battlefield for price itself. And battlefields follow incentives. At any given moment, outstanding paper claims can represent multiples of the silver readily available for delivery. To an inexperienced observer, that may sound alarming. To a seasoned market operator, it reveals the core assumption holding the system together. Most participants never intend to take delivery. They plan to close, roll, offset, or cash settle positions long before settlement becomes relevant. As long as that behavior continues, the system functions smoothly. But the moment too many participants move from paper intention to physical demand, stress begins to appear. This is where silver becomes uniquely sensitive. Unlike many purely financial assets, silver has an industrial life beyond trading screens. It is consumed in electronics, solar infrastructure, medical applications, energy systems, and advanced manufacturing. Once used in many applications, it is not always economically recovered at scale. That means physical supply is not simply a number on a spreadsheet. It is tied to mining output, refining capacity, logistics, recycling economics, and real-world demand cycles. The paper market can expand rapidly through contracts. Physical supply cannot. That mismatch creates a hidden tension. When investor demand rises at the same time industrial demand remains firm, the visible chart may appear calm while structural pressure quietly builds underneath. Inventories matter more. Delivery behavior matters more. Lease rates, spreads, and warehouse trends begin telling a deeper story than headline prices alone. Yet many retail participants never look there. They watch candles. They follow opinions. They react to red days and green days. Meanwhile, sophisticated capital often watches entirely different indicators, where inventories are moving, where contracts are concentrated, how options are positioned, and whether weakness is occurring despite tightening fundamentals. This is why silver can decline even while the underlying market becomes tighter. If speculative longs begin crowding into bullish positions, the fastest way to cool momentum is not to solve the supply problem, it is to pressure the paper price. A sharp futures sell-off can damage sentiment immediately. It can force leveraged traders out of positions. It can create headlines suggesting demand has failed. It can delay the psychological effect of scarcity by replacing confidence with doubt. The metal has not changed. Perception has. That distinction is where many lose discipline. Business leaders understand this pattern outside markets. A company with strong fundamentals can see its stock fall on sentiment. A valuable product can be discounted during temporary panic. A growing sector can look weak during a liquidity squeeze. In each case, surface price and underlying value temporarily separate. Silver often lives in that gap. None of this means the paper market is fake or irrelevant. It remains central to hedging, liquidity, and price transfer. But when participants confuse derivatives activity with the full reality of supply and demand, they risk misreading the entire landscape. The smarter question is not whether paper markets exist. It is whether the current paper move is confirming or contradicting physical reality. If inventories are shrinking, industrial demand is steady, and monetary concerns remain elevated, then a sudden price drop may carry a different meaning than it appears to on the surface. It may signal liquidation. It may signal positioning stress. It may signal tactical pressure inside the derivatives complex, or it may be the market offering lower prices while the underlying problem remains unsolved. That is why serious observers study both worlds at once. They watch the visible arena of futures pricing, but they also watch the slower, quieter world of physical availability. They understand that leverage can move price faster than fundamentals in the short term, but fundamentals tend to matter more over longer horizons. And this is the hidden mechanic many never learn until after costly mistakes are made. In modern markets, what is easiest to see is not always what matters most. The chart is visible, the contracts are visible, the headlines are visible. But beneath those signals sits a harder question: how much real metal exists, and how many claims already depend on it? A market decline is not always just a decline. Sometimes it is a message, sometimes it is a test, and sometimes it is a mechanism designed to produce a predictable human reaction. Silver has a long history of attracting participants who enter with conviction but operate with fragile discipline. They understand the bullish story: currency debasement, industrial demand, limited supply, monetary uncertainty, but many are unprepared for the path prices take on the way to any larger thesis. They expect the destination to matter more than the journey. Markets rarely reward that assumption, because in leveraged environments, psychology becomes part of the structure. The average participant imagines markets as a contest of information. Whoever knows more wins. In reality, markets are often a contest of behavior. Whoever remains rational while others become emotional gains the advantage. Information matters, but behavior decides who can use it. This is where the trap begins. When silver falls suddenly during a thin session, the first casualty is not capital, it is confidence. Screens turn red, social feeds fill with explanations, influencers reverse their tone, comment sections become crowded with certainty after the fact. Traders who felt intelligent at Friday's close begin questioning everything by Monday morning. A thesis built over months can be abandoned in minutes, not because fundamentals changed, but because emotion accelerated faster than analysis. Fear spreads efficiently because it feels urgent. A slow decline invites thought. A violent drop demands reaction. That urgency is powerful. It triggers deeply human instincts. Preserve what remains. Avoid further pain. Do something now. In normal life, those instincts can be protective. In markets, they are often exploited. The person selling under pressure may believe he is making an independent decision, while in reality, he is responding exactly as the structure anticipated. That is why the most expensive losses are often self-inflicted. First comes the price shock. Then stop-loss orders are triggered automatically. Those forced sales create additional downside momentum. Margin accounts receive warnings. Leveraged traders reduce positions not by choice, but by necessity. Observers interpret this mechanical cascade as proof that smart money knows something. New sellers join late. The decline deepens. What began as pressure becomes narrative. And narrative is contagious. Once enough people believe the move is meaningful, they supply the energy to extend it. This pattern exists far beyond silver. It appears in equities, real estate, currencies, and private business cycles. A rumor affects confidence. Falling confidence affects behavior. Changed behavior creates the outcome people feared in the first place. In this way, perception can temporarily become reality. The disciplined observer studies that loop carefully. He asks whether the move created new facts or merely new emotions. That question matters because retail participants often confuse discomfort with danger. If a position becomes emotionally painful, they assume it has become fundamentally wrong. But volatility does not automatically invalidate a thesis. Sometimes volatility is simply the cost of participating in a competitive arena where weaker hands are regularly tested. The phrase weak hands is often misunderstood. It does not mean small investors. It means participants whose decisions can be controlled by short-term stress. A large institution can be a weak hand if it must meet redemptions. A wealthy trader can be a weak hand if he is over-leveraged. A retail investor can be a strong hand if he is prepared, liquid, and patient. Strength in markets is rarely about size. It is about decision quality under pressure. This is why manufactured fear can transfer assets from one group to another. Those who bought with emotion often sell with emotion. Those who entered with a framework often evaluate conditions calmly. One side experiences panic as proof, the other experiences panic as information. Neither side sees the same event. For entrepreneurs, the lesson is immediate. Markets are only one version of this dynamic. Competitors use urgency. Negotiators use deadlines. Media cycles amplify panic. Economic downturns shake confidence more broadly than fundamentals justify. In every arena, those who cannot regulate emotion are easier to move. Silver simply makes the process visible. A sudden crash can feel like the market is speaking clearly. Yet sometimes the loudest moments contain the least truth. Noise increases precisely when clarity is most valuable. That is the trap. Not merely the decline itself, but the reaction it extracts. Not the red candle, but the decisions made because of it. Not the volatility, but the surrender of independent judgment under pressure. By the time many participants realize they were reacting to structure rather than reality, the emotional selling is complete, the weakest positions are gone, and stability begins to return. Then headlines change. Confidence slowly rebuilds. New buyers arrive at higher prices. The same people who sold in panic now call the rebound unexpected. It was not unexpected. It was behavioral. And in markets where human emotion can be anticipated, fear is not always an accident. Sometimes it is part of the design. By the time volatility becomes visible to the public, the most important decisions have often already been made. Price is the final output, not the starting signal. And yet, most participants build their entire strategy around reacting to that output rather than understanding the inputs behind it. This is where sophisticated capital separates itself. It does not ask, why is silver falling today? It asks, what conditions made this move possible and who benefits from it? That shift in questioning changes everything. Because once the structure is understood, volatility begins to look less like chaos and more like opportunity, provided it is interpreted correctly. Smart capital does not operate on impulse. It operates on frameworks. When silver declines sharply, experienced observers begin with inventory behavior. They examine whether available metal is expanding or contracting. A falling price alongside tightening supply does not confirm weakness. It introduces a contradiction, and in markets, contradictions are rarely ignored for long. They tend to resolve one way or another. Next comes positioning. Large players track where exposure is concentrated. If speculative long positions had become crowded before the decline, then forced liquidation can explain the move without requiring a change in fundamentals. In such cases, price weakness may represent a reset rather than a reversal. Understanding that difference is critical because reacting to a reset as if it were a collapse leads to poor decisions. Then comes liquidity. Not all price moves are created equally. A decline during peak trading hours with broad participation and high volume carries different meaning than a sharp move in thin conditions. Smart capital distinguishes between these environments carefully. A move that requires minimal volume to create maximum impact often reveals more about timing than conviction. Options markets add another layer. Sophisticated participants monitor where options exposure becomes sensitive, where price movement forces hedging activity, where gamma dynamics accelerate trends, and where expiration cycles create temporary distortions. These forces do not change long-term value, but they can heavily influence short-term direction. Ignoring them leaves a participant reacting to symptoms rather than causes. Finally, there is the macro context. Silver does not exist in isolation. It responds to currency conditions, interest rate expectations, liquidity cycles, and broader economic uncertainty. If the macro environment continues to support hard assets through monetary expansion, debt pressure, or declining confidence in fiat stability, then temporary price weakness must be evaluated within that larger framework. This is how serious decision-makers approach markets. They do not seek certainty, they seek alignment. If multiple structural indicators point in one direction, while price temporarily moves in another, they do not rush to follow the price. They pause, they observe, they ask whether the divergence is noise or signal that has not yet fully expressed itself. That discipline is rare. Most participants prefer clarity, even if that clarity is misleading. They want markets to confirm their beliefs immediately. When that confirmation fails, they abandon the belief rather than re-examining the conditions. In doing so, they trade conviction for comfort, and comfort is often expensive. For entrepreneurs and business leaders, the implications extend beyond silver. Markets are simply one environment where perception and reality can diverge. The same principle applies to industries, investments, negotiations, and strategic decisions. Short-term pressure can obscure long-term value. Temporary weakness can create asymmetric opportunities, but only for those who remain analytical when others become reactive. This is the unspoken reality behind many market moves. Not every decline is a warning. Not every rally is confirmation, and not every opportunity appears attractive when it first emerges. The Monday trap, in this context, is not just about silver. It is a case study in modern market structure, where liquidity, leverage, psychology, and incentives interact in ways that can mislead the unprepared. What is visible is often engineered to provoke a reaction. What matters is often hidden beneath it. Those who learn to read that hidden layer do not eliminate risk. That is not possible. But they reduce unnecessary mistakes. They avoid reacting to every fluctuation. They build strategies that can survive volatility rather than collapse because of it. And over time, that difference compounds. Because in complex systems, success rarely comes from predicting every move. It comes from understanding how the system behaves, especially when it appears most unstable. Silver is simply offering a clear example. A market where price may fall while pressure builds underneath, a moment where fear becomes visible while structure remains unchanged, and a decision point where participants must choose, follow the move or understand it.